Good afternoon, everyone. Thanks for joining us here on this panel about central bank policy. My name is David Zervos. I work at Jefferies, and I'm joined here by a very distinguished group. I'll just run through who's with us today. We have Jim McCaughan from Principal Global Advisors, the CEO. We have Cliff Noreen, the president of Babson Capital. So we're running down the row from my far right. Tad Rivelle, CIO for fixed income at TCW. Aram Shishmanian, who is the CEO of the World Gold Council, and Kevin Warsh, visiting fellow at the Hoover Institution and ex-Federal Reserve Board governor from, I guess your last day was 2 years, a week, and 3 days ago was what you mentioned to us earlier. So remembering it very fondly. I think we have a very exciting discussion for you guys, and if we have some time at the end, we'll try to open it up for questions. It was actually in this room last year that we were sitting. I think Cliff was with us, but we again had a few CIOs and a few Fed people. At that time, we had Dennis Lockhart and Charlie Evans, Dennis from the Atlanta Fed and Charlie from the Chicago Fed, and we were talking about the limits to monetary policy. That was the title of the panel last year. And this year, quantitative easing or quantitative exhaustion, I think sort of is a very similar theme. So clearly we haven't progressed that far from understanding how much we like QE, how much we don't like QE, whether there's limits, whether there's not limits. But I thought what was fascinating about last year's panel was when we were asked about the limits to quantitative easing, everybody sort of had some concerns about costs and pushing on a string and diminishing marginal returns, and I'm sure we'll hear about that further today. But Charlie Evans stood up and basically said that his answer to those two questions, the question of what are the limits to monetary policy, his answer was there are none. And I found it interesting because in the last 12 months, a lot of what the Fed has done is follow Charlie Evans' rule of pursuing perpetual and limitless QE until the unemployment rate drops below 6.5%, as long as the long-term inflation expectations as measured by the Fed don't increase above 2.5%. And that was, I think, dubbed the Evans rule by many in the market and even some at the Fed. So we're sitting here again kind of asking ourselves the same question on limits, and I wanted to propose to each of our panelists a basic set of questions and then have them open it up for discussion. So everybody will get 5 minutes to kind of pontificate on their thoughts about QE, and then we'll open it up for a more active debate. But I'd like each of you to address how successful you think QE has been and what parts of the economy have been affected the most beneficially and what parts have been affected the most negatively. Are we seeing diminishing returns to additional QE? And at what level of QE, in terms of the size of the balance sheet of the Fed, would you say that the costs begin to outweigh the benefits? And we'll start at the end with you, Jim. Why don't you take the lead, and we'll go down the line.
Thank you, David. I would suggest that the first 18 to 24 months of QE was an outstanding success. And it was an outstanding success because at that time, bank balance sheets were really short of liquidity. Liquidity was what they needed to provide and generate credit. About the time QE2 came in, which must have been late 2010, I guess, that's when I began to have my doubts. And I think my doubts started with the QE is filtering into markets, but the market it's filtering into most is commodities. And I would argue that's because commodities mostly trade on margin and therefore don't need much liquidity to push them up. So what were commodity prices doing? They were flat when at a time when they really should have been going down because of excess supply. And of course, high gasoline prices in America are equivalent to a tax increase. So I think that was already holding back the economy by early 2011. I think now you see a second negative of QE, which is that low interest rates are taking away from the income of retirees. And that's true every time a retiree has a 5-year CD expire, their income goes down. And by taking away from the income for retirees, you know, whether you think that's socially desirable or not, I suspect it isn't, it takes purchasing power out of the economy. So that's two ways that QE is now holding the economy back. My belief is that QE was a spectacular success to start with and became a liability. The headwinds exceeded the tailwinds by about 2 years ago. And why, therefore, is the economy still progressing? Well, I think basically the Fed got lucky. There are other things going on that are nothing to do with monetary policy. Cheap energy, the housing market turning around because inventories have been worked through, the innovation and productivity of the US workforce. Those are the reasons why the US private sector is doing so well, and monetary policy is probably just holding it back a bit. But hey, if you get unemployment come down 6.5%, the way various Fed spokesmen have talked about, the Fed will be able to declare victory. And I don't really care if they declare victory, even if they didn't cause the victory.
Cliff, you wanna give us your thoughts on if
Sure.
2010 was a critical turning point there for QE, or?
I'd like to just step back and just review what happened here. In the lunch session, one of the slides showed the markets hitting all-time highs in the fourth quarter of 2007. If you step back to that period, in September 2007, the Fed funds target rate was 5.25%. That's much different than we are today. It's hard to even remember that far back how high interest rates were. And over the next 15 months until December 2008, there were 10 drops, 500 basis points. They ranged from 25 to 75 basis points, but 500 basis points in total to get to 0.25%, which is where we are here today. In November 2008, QE was announced. It was implemented in the first quarter of 2009. And at first, this was thought to be a short-term phenomenon to help jumpstart or leapfrog the economy from where it had been in the doldrums. So you have to think back and say, this has been a highly unusual, unconventional method of monetary policy. And you have to ask whether this is now becoming more conventional or more accepted as a normal economic monetary policy. And it's been going on for almost 4.5 years. And it's had a lot of effects on the economy. I think the biggest beneficiary, two biggest beneficiaries, one has been the federal government, and two has been corporate profits. If you look at slide 29, or slide 30, you can see corporate profits here.
Can you pull up slide 30, please?
And corporate profits are really what drive the stock market eventually. QE is driving it right now, but in a long-term investing perspective, corporate profits are what will drive individual stocks in the stock market. So you can see back in 06 and 07, profits peaked at about 1.6 trillion. They dropped over 50%, about 55%. And that's almost the exact same amount the stock market dropped. The Dow dropped from 14,000 to roughly 6,500. And corporate profits have rebounded back, now exceeding the old highs of 1.6 trillion, about 1.75 trillion. So profits are up over 10% over the previous peak. And you think about it, and the economy has really struggled. The economy has grown 1.6% since the first quarter of 09. On a long-term basis, since the end of World War II, it's grown 3.2%. So it's grown at half the rate. Yet corporate profits are booming. They've never been better. Now, wages are one of the reasons. I don't have a slide on this, but wages as a percentage of GDP are way down, and profits are way up. And the other beneficiary has been the federal government. If you look at slide 32, please, you can see gross federal debt. As we entered this crisis, debt was between $9 and $10 trillion, and now it's approaching $17 trillion. And if you look on the next slide, on slide 33, the government's really benefited because the average cost of its debt was around 5% when we entered the crisis. Now it's half that, 2.5%. So we've almost doubled the debt and had the interest expense go down so much because of overall rates. And as you know, the government's been funding their balance sheet and their debt very much short-term, about 70% of it short-term. So they've been the biggest beneficiary along with corporate profits.
Ted, you wanna pick up from there?
Sure. Well, obviously, the matter of quantitative easing is complicated, of course, and it bleeds into ideological and political type questions, as economics necessarily does. But let me just frame a couple of maybe talking points or issues that maybe merit some further exploration. I think a good organizing first step might be this, is that in 2009, the Fed's diagnosis for what ailed the economy, I think, was in sum and substance correct. It basically said, we have a Keynesian problem on our hands. We have a shortage of aggregate demand. It's sudden. It's the loss of animal spirits. The businesses, they're freaked out. The consumers, they're freaked out too. Somebody better step into the gap and do something. And what we did was something was actually the right thing. It's that Keynesian medicine that is supposed to be applied at that point in crisis, basically to prevent an uncontrollable slide and a sudden jump, if you will, to a condition of fallow resources everywhere you look. But that was some time ago, obviously. And over the course of this period of time, it's necessary, I think, to ask some additional thoughts and questions. Is the problem that confronts us essentially one of aggregate demand, or are there other issues that are being exposed by the fact that maybe we solved the aggregate demand problem, and now is it possible, this is an amorphous term, is it possible, I think we should at least be having the policy discussion, that the United States suffers from some type of a competitiveness problem, that it has the wrong configuration, the wrong mix of labor and capital along the lines of some of the structural problems that we see in Europe. The thought experiment, if you will, would be this, is that if a new government took over in Greece tomorrow and said there's a lot of smart guys in the United States, some of them have been teaching at spanking good universities like Princeton University, and all that we've been hearing in Europe for years is that it's structural problems and we got to fix our microeconomics and our labor markets. Maybe we should just forget about all of that hard work, basically, of changing and transforming the microeconomic elements of our economy. And maybe what we should do is do what the Americans do. So if that was being applied to Greece, Greece would say, let's drop out of the euro, we don't need it, we'll print the drachma, we'll spool up our demand side of our economy, it will party. As the demand side of our economy parties, it will close the output gap with the supply side, our unemployment rate will come down and our problems will be solved. Everyone in the world would look at that and say, okay, the madmen have taken over in Greece, and this is going to end very, very badly. But when we look at that problem in the context of the United States, we say, no, 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 we don't have a competitiveness problem. We got that problem that our politicians tell us to. But I think a point to look at this a little bit more deeply would be this, is it not the case that economics textbooks teach us that those that are closest to the economic decision making, the microeconomic actors with the best local information and the most skin in the game, the most reason to get the decision right, the basic premise of capitalism is trust those people to make the choices as they relate to buying and selling, and by the way, I think you could extend it to borrowing and lending. The problem in the case of the United States as it relates to quantitative easing is that the Fed basically looks at the lay of the land. There's an exigent level of interest rates. There's a certain amount of credit creation. The Fed looks at that and says, that's the wrong answer. There isn't enough credit creation. We need more. And consequently, every element of zero rates and quantitative easing is designed, in effect, to a certain degree, instruct back the micro actors of the economy to go and create more credit. A final point that I'll make about all of this is that when credit and savings get talked about, they get conflated all the time. There is a certain amount of resources, as we know, that are not used for current consumption, and those are saved resources. Those are lumber and concrete and steel and all sorts of material that can be used actually to improve and to expand the frontier of productive capacity of a particular economy. When you start to create, your fractional banking system, however, I guess I should put it this way, can take that fixed pool of savings and produce an almost infinite amount of credit on top of it. But what I would suggest to you is that the more credit creation you do at some point, not only are you introducing more leverage somewhere into your financial system, you have to be doing nothing more than redistributing at some point, because you just don't have the fundamental underlying resources basically to put to work. There are some limits to it.
So we're not getting any fans of QE after three attempts.
Go for three.
At least post November 2010.
Right.
I'm guessing, Aram, that you're not gonna jump in and be at the center here.
I will build on all the comments, but I would say I am a fan because at the early stages, what were the alternatives? We had faced a situation where there was the collapse of our system, and it was because of lack of risk management. The politicians couldn't do it, the financial system couldn't do it, the intermediaries couldn't do it. So I think it was necessary for the central banks, one of the few tools that they have was monetary easing. And we may be critical today, but it was essential that we didn't fall off the precipice. So to that extent, and I won't put a date on it, whether it was November 2010 or whatever, but was it essential? And has it taken us forward? Absolutely. The issue today, though, is not a matter of how much more it will continue and when will it stop, because we're not entering diminishing marginal returns. I think we all understand that's the case. Actually, we're increasing negative outcomes, because the resolution, as the previous speakers mentioned, is not just fiscal policy, monetary policy. It is fiscal policy. It is structural changes that need to be made, and it's also the gridlock in the political system in the US, but also in Europe. And to provide a single medical cure, and I was struck by Mohammed El-Erin's comments at breakfast about medicine and QE being, the pharma industry being the same in coming up with a new medicine and giving it to the patient, and it hasn't been tested. And I think that was a fantastic analogy. But the trouble is that medicine is being applied to 3 fundamentally different patients. The situation in Europe, which we all know is dire, and is not likely to get much better in the near term. The US, which has early signs of progress, yet market expectations has exceeded reality. And then in Japan, it is just beginning to start. I think the issue we face is we're in a world of discontinuities and of unknown outcomes. And the discussion I've heard in the last few days, and certainly for some time, is unintended consequences. And therefore, QE, I think, now has served its purpose. The real question is, how do we get back to real growth, sustainable growth, and risk-mitigated growth, and not just go back to risky assets? I think the lesson we learned from 2008 was that not only is it about wealth creation, but it's about wealth preservation. And I think we need to also go back to the very people that it's affected, and the very first speaker mentioned about pensions. And I think that's a very useful way of looking at this, because of the aging populations in all 3 regions, in particular Japan, their wealth has been decimated. And when they retire, they'll even get less. And the question is, how do we ensure that what is remaining in their pension pot is safe? And how do we create true structural benefits and change through both economic growth, but also policy changes in terms of entitlements for others in this mechanism? We've talked about Spain. I've heard it a few times. I was there a week before last, and it is truly shocking. I was on a coastal town where it was quite affluent, and you just go a couple of miles north into the hills, and you can dramatically see the unemployment levels. So we can talk about the theory, but we've got to get back to really understanding the huge impact it has on households and families, and particularly in all those societies, not in China and in India at the moment, the aging population.
Kevin, I think you actually wrote a Wall Street Journal editorial that was quite famous right around that November 2010 period, if I'm not mistaken, that also at least echoed the first 3 speakers' views. I wonder how you're thinking about it today.
Right, so thank you very much for having me. I wish I could jump into this debate and take the other side of it. Instead, I will just pile on my dear colleagues who are still in Washington. I think the early description here has it about right, which is if you go to the deepest, darkest days of the financial crisis, where financial markets were not functioning, bid-ask spreads were wide and markets weren't clearing, and you wanted to look at what's the role of a central bank, I would say in 2007 and 2008, that reminded me a lot of panic of 1907. It's a financial panic. And as a result, when you look at untested experiments, you'd say, well, maybe this is the moment where we should be myopic. Maybe the goal of the central bank should be very aggressive for a short period of time to get markets to clear again. And by that judgment, addressing a financial panic, I happen to think then and think now that was the right thing to do. We can have a long fight over causes and consequences and how we found our way to that perilous point, but the risk reward to me didn't look like a tough call. But we left a financial crisis now more than 4 years ago. I understand why the politicians call this a crisis. For them, it is a crisis. They're presiding over an economy that is refusing to grow at the pace of post-war recoveries. The recovery from this recession is anemic. They have run out of excuses. And those that preside over weak economies tend to lose office. So I understand why they call it a crisis. And they might well put a name on it and talk about a crisis in the labor markets and a crisis for those seeking work, and that's fine. But the ability of a central bank exclusively, without the rest of Washington doing any bit of the task, to turn an economy from a modest recovery to a robust one is an experiment that is untested and, in my judgment, will not prove to be successful. The Federal Reserve, since the darkest days of the financial panic, has taken on, assumed, the obligation to solve for the shortfall in aggregate demand that was mentioned, and is prepared to do it by itself. Now, I don't think it means to. I give Chairman Bernanke and his colleagues enormous credit for good intentions, but good intentions will not turn an economy that's been growing a little less than 2% to an economy that's growing at 3.5 or 4, which is the kind of economic recovery we need to put people back to work, to have our average hourly earnings go up, to have sustainable improvements in the labor markets. So in my judgment, over the course of the last several years, the Federal Reserve has overpromised and underdelivered. And for a central bank whose most important asset is nowhere on its $3.2 trillion balance sheet, but is the institutional credibility that we inherited from our predecessors who served at the central bank before us, that is a risk that strikes me as an imprudent one to be taking. But the longer the Fed has been in this game, the rest of Washington is looking to them to pull more rabbits out of the hat, just like we did in the darkest days of the financial crisis. As a result, other pro-growth policies on trade and taxes and spending and regulation have been nowhere to be found, with more burdens put on a central bank. If the history of economies, recessions, recoveries tell us anything, it says that this mix of policies has to be right. And when one part of government tries to solve it by itself, it tends to lead to chronically mediocre results. Stepping back, I would say Washington has done its level best since the darkest days of the financial crisis, from that moment to this, has done its level best to focus on GDP in the next quarter and maybe before the next election, and preciously little to help the economy 3, 4, and 5 years out. As a result, in spite of Washington's best efforts to kill this economy, they have failed. The good sense of the American people continues to prevail, and the economy is growing probably about as fast as it can, given this mix of anti-growth trade policies, regulatory policies, and the like, and the central bank finds itself with fewer degrees of freedom. So I'll close where David began, which is the reason why we're having, in some sense, a similar discussion this year that was had last year and the year before, is to be quite plain about it. There is no plan B. The Federal Reserve, in my view, finds itself with fewer degrees of freedom, and the rest of Washington is not coming to their rescue. More important, central banks do not act in a vacuum. The Federal Reserve is not just another central bank, but the most important central bank in the world. We happen to have the world's reserve currency, and the world's central banks are confronted this sort of aggressive policy, and they feel often compelled to match it for reasons of economics and competitiveness and trade flows and the rest. So I think the U.S. economy will continue to be growing around these levels, will not break out to the upside. And as a final point, I will say in Washington, they would say, well, this is because of bad luck. This year's bad luck is because of the continuing weaknesses in Europe. Last year's bad luck was because of fights between politicians over budgets. But it's not bad luck 4 or 5 years since the financial crisis that is creating this poor result. It's bad policy. And to my old colleagues at the Federal Reserve, as I said, I think they've got great intentions, and their policies working in concert with others could produce dramatically different results. But I see the Fed regrettably continuing to act alone, and I wonder whether 12 months hence we'll be coming back to a similar discussion, and the description will be about the bad luck that's again hitting the global economy.
So I'm gonna try to at least get some debate going here, because it's very troublesome to have agreement at one of these sessions. I was fortunate enough to spend a few weeks ago some time with Chairman Bernanke down at the Atlanta Fed, and he gave a very interesting dinner speech. And if you listen to the way that the champions of QE describe it, and I'll put my champion of QE hat on, which I do quite often. They talk about a portfolio balance channel, and they talk about reduced animal spirits. They talk about an economy in 2008 that was on the precipice of disaster, where everybody had lost large portions of their wealth. Their house was down, their 401k was down, their kids couldn't get jobs, their friends were being foreclosed on, there was no access to capital. And their instinct was to hoard and not take risk. And part of what you hear from the champions of QE and those that are trying to still push it today is that part of their job is to reignite those animal spirits, those Keynesian animal spirits that ultimately drive us out of the business cycle, to use the portfolio balance channel to get us out of that hoarding mode that we all got in 08, 09, and even to some extent in 10 and 11 because we kept getting flare-ups in Europe and in other places, and drive us into taking risk by making it very expensive to hoard, by driving real rates negative, very negative in fact. Negative 2%. Average inflation in the last 2 years in the United States, headline CPI has been 2%. And T-bills earn 0. So you've had a penalty for sitting on cash. And we sit here today with the equity market at record highs. We sit here today with unemployment having come down from double digits to something more respectable. Not great, could be better. We have a very modest level of inflation. And we have an economy that, while it's not growing at the pace we would like it, as Cliff points out, we have an economy that's actually growing after we just witnessed one of the greatest crashes of our careers.
Yep.
We came out. And we are running the greatest monetary policy experiment of all time. There's no question about it. And getting out of it, as I think Aram was discussing, is probably the most important thing. We don't know how we're going to get out of it. But the fact is, if you went back to 2010, and I'll ask all of you, if you went back to 2010 and said, we're not doing it anymore, balance sheet stays the same. We put Jean-Claude Trichet at the head of the Fed, okay? That's the trade. And we watched the thing ride. Would equity prices be here today? Would house prices have turned around? Would we have unemployment lower than in the end of 2010? Or would we actually have had some sort of 1930s response where real rates went higher, people continued to hoard, there was no risk-taking, there was no resurgence in animal spirits, and we actually had a very, very negative outcome? I'll start again with Jim. I had to do that because you guys agree too much.
I suspect, and as I said earlier, and I think there was a consensus for this, that QE was and asset purchases in particular, were the right policy in 2009 and 2010. And as I said at the beginning, I see it as being more than a diminishing return. I actually see it now as being counterproductive. So I do believe there is a point sometime between late 2010, maybe to the end of 2011, where a reduction in QE might actually have improved things a bit, because you'd have probably seen commodity prices a bit lower, and you might have seen the retiree less squeezed. So I do think that there is a point back there when it would have been better to have toned the policy down. But you know, Kevin talked about the anemic recovery, and I think it's kind of interesting to put this in context. Slide 3 shows the recovery in UK, Japan, US, and 2 representative Eurozone countries. That's Germany and Italy. If you think of the Eurozone, it's probably a weighted average of Germany and Italy. So it's right on top of Japan and the UK. That shows we're doing really pretty well compared with those others. Maybe our fiscal policies and our regulatory policies, while we can call them inept, may not be as inept as some of those other countries. If you look at slide 1, however, that was on when you came in, this shows that all of these countries have actually expanded the balance sheet. You know, you mentioned Monsieur Trichet, but hey, there's only a flat period in the balance sheet, and it's been expanded since he left.
Yeah, the only time it went up that second time was after he left. And
after he left.
You had an Italian in.
That was Senior Draghi, yeah. No, that's correct. And so Monsieur Trichet had the initial rise and then the flattening out. But you know, if a big balance sheet at the central bank was going to lead to a prosperous economy, we in the US would be way behind Japan, the Eurozone, or the UK. I just don't buy the argument for keeping on forever with a policy that was really pretty good at one point.
Cliff, how do you respond?
Well, if we were sitting back here in 2010, let's go back 3 years, I don't think there'd be many people in the audience or on the stage here who would think that we'd still be in the same position implementing QE 3 years later. And I'd pose the question, if we fast forward to 2016, where are we going to be then? we're going to be still in the same stage here. And I think a lot of the problem with our economy, we've done everything we can monetarily. We put our foot down to go 120 miles an hour with rates as low as they can go, at 0 in the short term, and in 10 years at 160 today. There's other things that we could do in our economy. We have an energy opportunity in our country that's beyond belief. Our imports have dropped from 11 million barrels 6 years ago down to 6. We've been producing 7 million 5 years ago, now we're at 9.5. If we actually push this along with natural gas, our economy would be growing much more than it is today. There's other things our government could do from a fiscal perspective to put confidence in business leaders and confidence in the business system to try to help our economy grow more. And we're not doing any of that. We're just sitting here. So we're doing everything we can monetarily, policy-wise, but we're not doing it on a fiscal policy basis.
I'll jump in and continue on some of these themes. Just, I think, maybe to reiterate the point, I think that actually is pretty unanimous. I think we all say that the Feds had a job of lender of last resort, which they needed to execute. They did execute it. But the problem becomes is what happens when lender of last resort becomes the primary supplier of credit or pricer of credit or influence on the market to the point at which it's affecting in a very significant way the pricing of credit in so much of the capital markets of both the US, in the dollar markets, as well as around the world. The Fed has, as we've said, defined one element of the problem as basically being a shortage of aggregate demand, and it's all being done in the service of fixing the labor market. Now, if you look at the labor market, while it's true the unemployment rates have come down, if you actually adjust those unemployment rates for the drop in the labor force participation rates, the numbers are actually pretty disappointing and pretty dismal. The number of people who are actually working has barely budged over the course of the last several years. So it does suggest that while the Fed, I'm sure, stabilized and probably prevented something like a 1929-1930 episode, we're forever grateful for them. But the question is does it remain as an appropriate policy going forward? Well, I posit the following. If you are a believer, I think, that the Fed has got this right, then we are probably on the verge of a Keynesian recovery very shortly. I don't think that we're going to have to wait very long, because I think that the Fed's theory has been that we lost a lot of jobs, particularly in the real estate related trades, constructions, mortgage traders, mortgage brokers, mortgage this, that, and the other thing. If we get the housing market rocking and rolling, those people are going to be put back to work and it's all going to be solved. Or, alternatively, what we're going to see, I think, over the course of the next 18 to 24 months is that the housing markets are indeed going to go rocking and rolling, but they are already in the process, at least in some geographical locations, some of which we know well locally, that are beginning to decouple from the wage market. And we've been there and done that. You know what happens when asset prices start to decouple from something that is more fundamental. While obviously housing prices is also complicated, I think that you can say that a housing price ought to be, you would think, more or less derivable from the prevailing level of wages, interest rates, availability of credit, and things like that. You just can't drive it 20% higher year after year on a compounded basis without ultimately getting to a place that will be not credible to the markets. And what may happen is that you pound your fist on the table in Washington and say QE forever until we get to 6.5% unemployment. The risk here is that before you get to that 6.5% unemployment, you've doubled real estate prices in Phoenix, Silicon Valley, San Francisco, and Los Angeles, and the markets basically are at a place that is viewed as obviously unstable, and it will ultimately end badly in some way, an endogenous collapse in asset prices from that point, or some type of inflation if you don't collapse it.
The risk of this discussion is furious agreement.
I'm trying.
And in a way, just to re-emphasize that, and using the medical analogy, and the first boost was necessary, but the truth is that the rebuilding needed significant changes in policy, labor policy, social policy, taxation, and there is an impasse in American politics, as you know better than I, and it will resolve itself, but the focus should be doing it very quickly, because the QE is a drug. It's a drug which is not tested, and it is addictive. And the consequences are truly unknown. This is an experiment beyond the experience of anyone, any policymaker, of any academic or brilliant economist. And therefore, we've got to be very prudent as to how we come out of this, because we've got to think of a number of different scenarios. And the European situation is much worse than the US because there isn't a European Union, there isn't fiscal union, and you're getting these enormous tensions in Germany, and there's a risk that the government, the re-election later this year, will profoundly change the dynamics of Europe. And what we're seeing in a small country like Cyprus, and being extrapolated that it's the model for resolving Europe, is outrageous to think that you would renege on commitments to society, to savers, that their funds will be used to pay off a bank debt. And this is reverberating through Europe. So to think that Europe can resolve itself in the near term, I'm actually very skeptical. And Japan, the actions again in the short burst, and it's being called a bazooka by the Japanese, is an interesting one. But the real challenge is, where's the productive resource going to come with the aging population?
Kevin, do you buy the chairman's argument that rekindling animal spirits, the portfolio balance channel, the movement of people's capital away from buying T-bills that earn zero and into investment in shale gas, investment in the Human Genome Project, investment in Menlo Park, that transfer, that forcing or that penalizing of hoarding and rewarding of risk-taking that he's engaging in, do you think that'll have real consequences for economic growth, and that's a positive for what we're doing here, or do you not buy that argument at all?
So it'll have real consequences for economic growth. So a couple things. One is, I think the chairman finds himself with what he would suspect are terrible alternatives. He believes and wrote about and has written textbooks that describe that monetary policy should take fiscal policy as given and then move as adroitly as it can. And that was true in 1974, and that generally is a good first principle in the conduct of monetary policy. But when monetary policy does what I think many of us around here describe as perhaps necessary in the darkest days of the crisis, which is find its way at least to the edge of fiscal policy, finds its actions by suppressing long-term interest rates as aiding and abetting the deficits and debts that the governments are running up, then I think it's a little naive, a little disingenuous to suggest that monetary policy should forget about the rest of policy and just focus on what's in front of it. At core, what is QE? What is central bank aggressive policy about? To your point, it's about buying time. Central banks in the depths of financial crisis, even in old-fashioned recessions, change interest rates to buy time, to buy a window of opportunity for a real economy to rebalance itself. But if you've been buying time for 4 and 5 and 6 years, you have to ask the question whether you're buying time or selling it, whether you're crowding in other policies, crowding in the real economy, or crowding it out. And the more that markets perceive QE to be a permanent phenomenon, the more it fundamentally changes the business that the 4 gentlemen on my right are in, then you have to ask yourself, what would you do when the benefits of the policies that you have put in place appear to be quite small and the costs are unknown, uncertain, untested, and prepared to be followed by many of the world's central banks around the world? So that's point one. Point two, to your point about what a central bank should do, a central bank is blessed by not having periodic elections in even-numbered years that should come up on us and get central bankers to be myopic. Most of us have been sent to the Federal Reserve for terms of 12 and 14 years. The purpose of that, by design, when the Fed was created 100 years ago, was so central bankers weren't worried about GDP in the next quarter or the next election, but worried about the economy over the horizon. And that long-term horizon should mean that we ought not care whether the stock market is near its S&P high today. That might be of interest to asset managers, portfolio managers, and retail investors, but it shouldn't be top of mind to a central bank. Top of mind for a central bank should be, what kind of policies can we put in place so that capital and labor find their way to their highest and best use? So the economy 3, 4, and 5 years from now is getting to a newer, higher potential. And if we do that right, the stock market will take care of itself. And this theory of the case that we're going to be manipulating financial markets so that businesses and consumers feel richer And while they don't use this language, think about it in another context. What they really mean is that wealth will trickle down to real people that don't have risk appetites to participate in these risky markets. And the New York Times and others used to talk about trickle-down fiscal policy, and they used to deride it. Well, who are the great beneficiaries of these policies? Well, they're people with wealth and risk appetites. And so I would argue that in some sense, those that are able to play this game are doing quite well during these periods. But the real economic effects are not trickling down. The unemployment rate is down for bad reasons, not for good. And the real reason why central banks have become a dirty word on talk radio is at some level, real people that somehow sit somewhere between Los Angeles and New York have figured out this isn't useful for them. So I would say the central bank is overplaying its hand. And to your question about, well, what would you do in 2010? How do we judge the success? In 2010, Washington, the administration, and most central banks said, if we do this, aggressive fiscal policy and aggressive monetary policy, here are the wonderful things that will happen. The economy will reach well past its traditional potential. The unemployment rate will go down to 5%. Average hourly earnings will move. Judged by their own standard, this has been a very disappointing recovery. And so the question that will be in the room of the Federal Reserve over the next couple of days is the same question they've been confronted for a long time. What do you do when your projections continue to miss on the downside? And I'm afraid the answer that will be all too common by central bankers will be to do more.
Which is a great lead-in, I think, to turning it to a more international discussion. And I'll just, I want to throw this out for everybody because we focused a lot here on the Fed, and the Fed is a very small piece of the QE that's affecting us globally. There's a slide 43 I'd like you to put up, and it's probably my favorite slide when discussing what's happening with global asset prices. This chart shows global central bank balance sheets of the major central banks: Fed, ECB, BOE, Bank of Japan, Bank of Canada, RBA, PBOC, SNB, Swedish Riksbank, and the RBI. It basically shows that from the middle of 2007-8, that central banks, having gone from about 3 trillion to 6 trillion over 8 years, over the sort of next 5 to 6 years, have gone from 6 trillion to nearly 16 trillion. Central banks have bought or funded or taken out of the market $10 trillion worth of securities. CUSIPs that Cliff buys and Tad buys and Jim buys, and that we trade every day at Jefferies. They're gone. They're out. Agency mortgages, Japanese government bonds, and even equities. There's a big article about central banks having bought equities. The biggest violator of QE in the world of expanding balance sheets that we've been talking about has actually been the Swiss. They've had the largest expansion of their balance sheet from the beginning of 2007 of any major central bank. And they're buying everything. They're buying equities, buying government bonds. They're printing reserves to buy other people's stuff, something that I think the chairman warned us was a bad idea after the G20 two times ago. My question to all of you in the last 15 minutes or so that we have is, how do you, as a central bank, not join this party? How do you sit there and say, I'm not going to do it. I'm not going to put the medicine into the system. I know it's dangerous, but you know what? The Swiss tried to stay out, and their dollar Swiss went to 70, and Nestle and ABB and every Swiss company went banging on the door of the SNB and said, if you don't get this thing up, we're moving, we're leaving, we're out. Country over. So if you have the Japanese, if you have the Americans, if you have even the Europeans, although it started to roll over a little bit, but that probably won't last for long given the coming ECB meetings, you have all of these central banks effectively printing. That's just money creation. All that is, the only way they buy assets is by printing money, reserves and currency. Milton Friedman would look at that and say, that's inflationary at some point. How do you step away, say, I'm not going to do it? What would be the consequences from a competitiveness standpoint? And you brought this up, Tad, in your discussion about competitiveness. How would you stay competitive and not continue to just add when everyone is going down the same path? Start again with Jim.
Yeah, firstly, I don't think Milton Friedman would think that that chart was necessarily inflationary. I'd suggest you look at slide 22, which that superimposes the growth in the Fed balance sheet against US money supply. And Milton Friedman's famous line is that inflation is a monetary phenomenon. So, you know, the roots of inflation are basically not there yet. There's lots of liquidity being created in the banking system, but it really isn't feeding through to money supply growth or more bank lending. Not anymore anyway. It may have been the Band-Aid that was needed in 2009 and 2010. But, you know, while we're on this topic of inflation and where it all leads, I'd like to try to take issue with Tad's comments, rather dire forecast about the Fed exit. I'm actually much more worried about the European exit, because, you know, if you look at, I think it's slide 21, you'll see that very similar chart for Europe compared with the Fed. They've done a lot of effectively quantitative easing, albeit much of it was indirect through things like the LTRO. What this tells me is that Europe has got the same issue in terms of an extraordinary growth in the Fed balance sheet and in bank liquidity. But the key difference is Europe has rising unemployment, not falling. So they have no credible exit route. That's where the problem 3-5 years out is likely to get really bad. In the case of the US, I'd actually take issue with a couple of comments that were made. This has been an anemic recovery, but it's not been totally jobless. In the Great Recession, 2008-9, we lost 9 million jobs in the US. We've put on between 4 and 5 since that recession ended. We're almost halfway back in terms of employment. That may be disappointing, but it's not as dire as some people say. It's not a totally jobless recovery. Indeed, combining those job growth with the withdrawals from the labor force, you now have an unemployment rate, what was the last mark, 7.6? It's not that far from the 6.5 at which the Fed is going to rethink. That's really the root of my comment, that we could be sitting here in 12 months' time and be in the midst of the Fed exit because they've been lucky and they have a victory.
But
I don't think they've really helped, but they could be declaring it.
you don't think that's going to be a messy exit, as per Tad's discussion?
Well, I don't. I'm actually quite impressed with the commentary that they've so far made on the exit around lower unemployment being the trigger and scaling the QE according to that. I actually think that's quite an optimistic message.
So anybody want to jump in on the international side, Japan?
Just on the international side, and you showed the chart of the monetary easing. The scale of monetary easing is breathtaking. But what is happening is we're forgetting that as we get increasing quantitative easing, there's this competition going around, the so-called currency wars, and the reality, all of it is going down. And I think part of the consequence of the question you were raising is that we may find we're getting greater protectionism and nationalism as one society wants to protect its own interests. And I think that's pretty dangerous because the three major regions don't include China and India and other very rapidly growing economies. And what they need is a multi-currency reserve system as they buffer against the US dollar in terms of the national reserves. So in terms of foreign currency reserves, it has grown from 2 trillion to 12 trillion today. And they need a resolution as well. The theme of this whole conference is solutions, and we've been, I wouldn't say wallowing, but depressingly talking about the problem. I can only offer 2 suggestions as to how we handle this. One is that we need to start discussing what a new monetary architecture should look like. It is futile to talk about national solutions because the US, and we've heard about its increasing anxiety about international competitiveness as a small example. This affects the world economy and the behaviors of 3 of the most important regions in the world, notwithstanding the importance of China. So I think both policymakers, central banks, need to have starting the dialogue to understand what the tenets of the new world monetary architecture should be. And we have seen radical changes in monetary policy, and no one has really said, wait a minute, it may have helped in immediate reaction, but where is it taking us? I think the second, and of course one scenario might be extensive inflation, the other could be a continuing struggle to go beyond inflation and sort of jettison out of it. But either way, we need to look at what are the risk mitigating actions we need to take to protect households, but also to protect businesses and nations. Otherwise, I think we'll find ourselves having this debate not only next year, but in quite a few years to come.
Kevin, you want to add to the...
Sure. So on the international front, we have one reasonably integrated global economy. There is one set of reasonably integrated financial markets, and that my colleagues are trading in. The notion somehow that there's not considerable leakage from one central bank's actions to the others, I think is divorced from the reality. If the Federal Reserve, which has traditionally punched more than its economic weight, we're going down a different path, I would venture to guess that many of the world's central bankers would be as well. No, they wouldn't be following, but there would be a different set of consequences of what happens when the world's central bankers decide to be this aggressive. And so the idea that is quite common in central banking circles, which is each of us just make the best judgment we can about our domestic economy and the rest of the world will figure it out by themselves, is not the world in which we find ourselves. And if central bankers in Asia, for example, are able to take license and do what they want with their own central bank policies and currencies by saying the magic words, which is, I'm only doing this for my domestic economy, we will find second and third order consequences of these policies. If you don't listen to the rhetoric of the politicians, but you follow the money, the trade flows, the capital flows, the liquidity flows over the course of the last several years, what you'd see is some indication that the air that we've been breathing for 30 years, air of globalization, that made us all look richer and smarter, more prosperous, with more opportunities for the next generation, that is not what the data of the last 18 months or 2 years are telling us. They're telling you there are threats to globalization, that there is a deglobalization wave. You see it in the banking sector, where banks are returning to their home country, where financial markets are increasingly segmented and distinguished, where home country bias is impacting investors around the world. I'm not here to call the end of globalization, but I am here to say that what we're seeing could be a cyclical phenomenon, but if policy doesn't get better, it will become a secular and structural phenomena. So discussions like this are very useful. Let me end with one positive note. If you were to subject an economy like ours to this mix of policies 5 years ago, predict that 5 years ago and see these policies were in place for the last 5 years, I would predict the U.S. would have been back in a recession. These sorts of myopic policies, running fiscal policy like it's an infomercial. If you buy your cash for clunker by December, we'll throw in a home buyer tax credit by Christmas. If we were to run these sorts of fiscal policies, these sorts of uncertain regulatory policies where we've decided that we will favor our biggest banks and call them national champions, I would have figured you could have done much more harm to this economy than you have. Yet at the end of the day, there are still the kinds of improvements on the real side of the economy that, at least on a relative basis, makes the U.S. look not bad by comparison. Economic policy, including central bank policy, need not be perfect. But our mix of these four big policies of trade and taxes, spending and regulation, and monetary policy cannot be this destructive, cannot be this short-term oriented. If this mix of policies gets just a little bit better, where central banks return to their roots and stick to their business of price stability, buy time so the rest of the economy kicks in, the U.S. will surprise the world 5 and 10 years from now, where after trying everything else, we will go back to first principles and the U.S. economy will be the envy of the world. We will then show the world how to grow again, and the U.S. will be in a virtuous circle and not a vicious circle. It isn't too late, but I would say if we're continuing to meet years from now and having the same discussion, then we will get used to 2% growth. Our labor force will get used to this level of chronic unemployment. And while we might get a bit of schadenfreude by saying, well, aren't we glad not to find ourselves where our friends are in Europe, we will end up with an economy that is far less promising than the economy most of us inherited. And for that, us as at least former public policymakers would have a lot to account for.
We've got a few minutes, and I guess we've all said our piece, I guess, on what we think the right policy is. There's also the question of what the actual policy will be. What will Ben and Janet and the rest of the committee do over the coming quarters and years? And for portfolio managers and for those that are seeing currency wars, seeing QSIPs extracted from the market, seeing this constant never-ending QE, whether it's exhaustion, whether it has limits, whether it has long-term consequences, the idea that it's here to stay seems reasonably powerful. In that world, which you could take argument, maybe there's going to be religion tomorrow and all the central banks are going to agree not to do this anymore, how would you structure your investment portfolio? We have a lot of fixed income managers here, and fixed income is probably the hardest place. That's where financial repression hits the most. But I'd be very curious to hear from our three CIOs in a world where risk-free real rates are negative, where you can't get money taking duration risk, you can't get money taking that much credit risk, you can't get money taking, well, you can, but you get a lot less than you used to, and structured risk continues to get priced more and more aggressively. How do you position, and how do you think about hedging for that inevitable exit that in Tad's world is a little messy and in Jim's world is not so messy? I think we'd all love to hear the answer from the three of you. You want to start, Jim?
I'll start. Okay. On the outlook, I feel most likely you're going to see continued QE and very low rates for about the next 9 or 12 months. But sometime out there, unemployment gets down to the levels the Fed has talked about, 6.5%. Sometime out there, rates start rising. What does that mean? That means you've got to be very wary of being out on the yield curve in fixed income. There are many bond managers and many bond funds who have done well by pedal to the metal on duration. I think those funds and those managers are extremely vulnerable, and many of them actually don't really have the freedom of action to go shorter and to adjust to the new environment. So I think there is a big disappointment coming out there for a lot of the very successful bond managers. I do think controlling the duration, I think that spread will still be something you need to go for. I do think that that will still be rewarding so long as you don't take too much interest rate duration, which is what I'm really scared of on a 2 to 3 year view.
So credit and structure for you.
Credit and structure are the places to be.
Cliff?
In fixed income.
I don't have as much confidence as Jim that we're going to be having rates go higher that soon, 9 to 12 months. I think it's going to be more like 2 or 3 years. What we've been advising fixed income investors is to really think outside the box. There's very little return in traditional fixed income products. You have to fight for every basis point you get. And we're having them look at non-traditional fixed income like private placement debt, commercial mortgage loans, CLO liabilities. On the high yield side, looking at combination of European and U.S. high yield and European and U.S. loans. There's more value in looking at those markets together and trying to extract as much investment return as you can.
Tad?
Well, I think whether you believe QE is going to end well or badly, it's, so to speak, the law of the land, and you live with it and invest accordingly. I think what that means is after 3 or 4 years of the Fed's robust sponsorship of the risk-on trade, which has brought the rates down and compressed the credit spreads, this is the way the world looks. You have a category, a cohort of what I'll describe as traditionally described the riskless assets, treasuries, agency mortgages. Why should you buy that stuff in this type of environment? The only reason is because it carries positive to cash. And when it ceases to carry positive to cash, then look out, because irrespective of the end of QE, you're probably going to see a much higher rate environment. So the confusion of positive carry with positive IRR over a longer horizon should be avoided, obviously. You have a second cohort, which I'll sort of describe as it's your corporates, it's your high yield, it's your leveraged loans, bank loans, and so forth. And to a very great degree, I think that the fate of this cohort lives or dies by whether you think QE ends well or badly. Is that if it ends in the way the Fed wants it to, the spreads probably hold, or at least reasonably well, because equity market valuations will probably hold. If it ends badly, not only are rates going to go up, but the spreads are going to widen. Non-agency mortgages, which have been basically one of the most abundant opportunity set the last few years, there's an opportunity there. Why? Because It doesn't care why housing prices are going up. It doesn't care whether housing prices are going up because wages are rising or because the Fed is sponsoring moving money out of zero-rate bank accounts and into the housing market. It's making those bonds, those contracts more secure. So I'll just leave it with that.
I'm going to end with one final chart, chart 42. We have a few seconds left. And I found this chart striking. Chairman Bernanke actually brought this chart up at a meeting 2 or 3 weeks ago. And as we all want to get in his head and figure out where it's going as opposed to designing the optimal policies ourselves, the chairman said, the guys who first went off the gold standard were the guys who had the quickest rebound in the market in terms of industrial output. And this chart came up. Japan was the first to leave the gold standard. France was the last to leave the gold standard in the 1930s. Back then, the guys who printed the fastest, the quickest, expanded their balance sheets were the ones who saw the recovery happen. There's a lot of debate in the economic literature about whether this is due to productivity or whether it's due to actually monetary forces. But I will tell you the thinking that I see inside of our central bank is that bigger balance sheets are going to drive the portfolio balance channel to get real growth, and they're not going to stop. And there's going to be a lot less CUSIPs for you guys to buy across everything, across every asset, and that's a very reflationary world. I want to thank all of our panelists, and thank you for attending, and thanks to the Milken Institute for organizing the panel.